This week, Mike Privette from Return on Security is with us to wrap the cybersecurity market up for 2023 and put a bow on it. Then Pascal Menezes from MEF joins us to talk about building a certification program for SASE services. Finally, in the enterprise security news, Halcyon raises $40 million to battle ransomware, Okta acquires Spera, VC firm OpenView Venture Partners shuts down, a marketing company claims that, yes, your phone and smart speakers really are listening to you. Ransomware crews have no shame and will truly target anyone. Comcast gets breached. Are the latest SSH and OAuth vulns in the news really as bad as they sound? Last-minute breach disclosure rule changes. AI bots are selling cars cheap. All that and more in this episode of Enterprise Security Weekly.
This is a Security Weekly production for security professionals by security professionals. Please visit securityweekly.com/subscribe to subscribe to all the shows on our network.
Broadcasting live from G-Unit Studios in Rhode Island, it's the show where we talk security vendors and aren't afraid to name names. It's Enterprise Security Weekly. Welcome to Enterprise Security Weekly and happy winter solstice. This is episode 344, recorded on Thursday, December 21st, 2023. I'm your host, Adrian Sanabria, and joining me is both my co-hosts couldn't make it, so nobody is joining me. But it is the winter solstice. I have this lovely, it's kind of half art piece, half clock, called The Present, and it has a hand that goes around it once a year. And 12 o'clock on it is the winter solstice. And then 6 o'clock is the summer solstice. And right now it is pointing straight up. So always fun to see that hand on the clock go around once again every year. All right, quick announcement here. Security Weekly listeners, cyber threats are evolving. Is your organization keeping up? The 2023 Cybersecurity Year in Review is here. Uncover the latest challenges and strategic responses in CRA's 2023 Cybersecurity Year in Review, sponsored by RSA Conference. From the impact of generative AI to the risks of ransomware to navigating new SEC rulings, get ahead for 2024 with your free copy. Download the report at securityweekly.com/Year in Review 2023. All right, so in this segment, we're going to look back at all the funding and M&A news and market trends for 2023. We're excited to have Mike Privette, founder of Return on Security, with us to provide a tea and crumpet perspective from deep within his London-based cybersecurity lair. Return on Security is a dual-focused venture, a virtual CISO consulting service, and a newsletter media business. His newsletter, Security Funded, keeps us up to date on the latest market trends, funding, and M&A here at ESW, so we can help keep you up to date on all those things. Or you could just sign up for his newsletter and cut out the middleman. But then you wouldn't get to hear my rants. Welcome, Mike.
Thanks for having me on, AJ.
Yeah, thanks for coming. It's been overdue, I think, having you on. As much as we use your newsletter and me and you chat about stuff, it's good to finally have you on the show.
Yeah, good to be here too. It's exciting to finally be able to talk through some of the stuff. It's hard to find someone who nerds out about it as much as I do, so I like the chance.
Yeah, we have a lot of fun with it. Tyler Shields and Katie Teitler, who are usually there for the news segments, are both ex-analysts. So we still have that that desire to analyze and look at the market and look at how people are approaching things. I think PLG is a big trend that went back when we were analysts. We didn't really see that much that we see a lot more today. And yeah, I'm excited to get into what kind of trends we saw for 2023. So I wanted to start off with a little bit of background. We went into this year with a depressed market, and I guess this is a good time to share that screen that I was just showing you, Mike, if you agree.
Yeah, no, that makes sense.
Yeah, so this was 2022. We created this because we actually had graphics on this podcast, on-screen graphics that our production crew would throw up a unicorn graphic because every episode we had a new cybersecurity unicorn to talk about. And then we even had a decacorn graphic where it was a unicorn and our our production folks pasted a bunch of extra horns on the unicorn, and it had 10 horns on it. And we were even talking about decacorns. So cybersecurity startups with a valuation of 10 billion or more. And then it all just abruptly stopped, as you can see in this graph. So for those listening, the video version of this podcast does have some visuals going. So if you really want to see the graph, you can check it out, or I can describe it to you. And the orange bars here show the unicorns throughout early 2022, and then midway through in early June, they just abruptly stop. And then I've got a blue line here that tracks the layoffs. So we've got two, is that Y? Yeah, two Y axes here. One for the amount that the unicorns are valued at, and then the other for the amount of people who were laid off by cybersecurity vendors. And those swapped out very quickly.
Yeah.
Any thoughts on this graph, Mike?
Yeah, I mean, it's this is a great view at just the kind of like the emergency brake pull that happened in 2022 that, I mean, a lot of people honestly didn't see in the broader tech ecosphere, but absolutely did not see coming in the cybersecurity landscape because, you know, historically, at least for most of my career, which has been almost 20 years, security has always gone up and to the right, like no matter what. There's always more money for programs. There's always more funding. There's always more startups. There's always more people going IPO. And as that momentum built, more and more people got into the investing game, into the startup game. So it was like a virtuous cycle that just kept, you know, fulfilling itself. And then everything changed like midway 2022 with interest rate hikes and economic uncertainty across the U.S. and the rest of the world. So that it became a very different game at that point.
And if only cybersecurity problems also were solved with that same hockey stick up to the right progress that the cybersecurity market has enjoyed, right?
Yeah, that would be all too easy. If that was true.
we made a lot of people rich, and ransomware is more common than ever.
Yes. And so is cyber insurance. Those two things have been inverse or have been correlated tightly. The more ransomware, the more insurance, and the more people make money.
Yeah, at some point, hopefully solutions actually catch up to the to the market and the money being made. So kicked off. OneTrust laid off almost 1,000 people, and that was a big wake up call, I think. And that all happened at once. Like we literally had just seen two companies, Jupiter One and I think Vanta and Perimeter 81, all declare themselves unicorns, and 1,000 people get laid off by one company within like a week of each other. So we all thought we were losing our minds, but we already knew. I think in April we knew there was a problem with the market, and people were predicting that there's going to be a bit of a bloodbath. Valuations are going to get lost. I think in the public market we're already seeing it. We saw up to 90% of valuations lost in the public market for SaaS companies, and we're kind of using that as a ruler to try and estimate what would happen to the security market and valuations there, because as long as somebody doesn't raise another round, they're still a unicorn, right? Like they don't have a new valuation, so they can still hold on to that number from 2013 or whatever.
Yeah, exactly. And that's right too. And a lot of people were hesitant to
until they try to exit.
That's right. Yeah. Which that dried up too. I mean, the IPO market just went zero overnight, scorched earth across the board. Like nobody went IPO, regardless of sector. Which was very different because, I mean, there were probably like 50 or so a year across, all of segments, like tech included and cyber. So that was a very big change. It's using public SaaS and like enterprise SaaS companies as a barometer is a really good gauge, because it's after a certain point, that's what most cyber businesses become. It's like the mechanics of running that business. They just so happen to be selling a different kind of software. So it makes sense. But everyone thought cyber was special, and maybe it still is in some ways, but it still felt the pain.
Yeah. Yeah, so that's kind of the perspective we had coming into this year, into the beginning of this year. It was a lot of doom and gloom, a lot of people wondering, okay, how long is this? Clearly we're in a rut here, but how long is it going to last? A lot of people are shrugging shoulders. Some people are throwing out, a year, 18 months, 2 years, different numbers. And yeah, so what did you start to see? Like I noticed in your newsletter, I don't remember if you did it from the very beginning, but certainly in 2023, I remember you starting to put together those graphs that would compare 2022 to 2023, and they were pretty stark in the beginning of 2023. 2022 is, I mean, when we were in that orange bar area on the graph where I showed you, where we were still declaring new unicorns. Certainly there was a lot less funding, it looked like, in 2023.
There was, especially in the early half. So I did not cover it for the entire year, but it actually piqued my interest because after some of the data started coming in for the first 2 months, I'm like, hold on, something is very different about this, and I need to understand how it is over time. But even just looking back, Q1 was probably the peak of the wave. Like it had not yet begun to crash yet. But just in cyber alone, I tracked like over $6 billion in that quarter in 2022. Mm-hmm. You contrast that in 2023, same quarter, it's just under 3 billion. So like more than a 50% reduction on what was, what we'd normally expect in that time. But looking at Q2 in 2022, it dropped again, like 5.2 billion. So still very, very high, still a very strong quarter. It was on pace to beat 2021 if you look at that, average out across the whole year. But that's when the brakes started putting on. But typically when these funding rounds happen, they're long planned. Like the allocation of money has been long planned for months, especially the larger the transaction, the longer it takes to get all the stuff lead time. And so some of these paths were already set, and so they had to, some of them had to make bad investments, or some of them had to make good on what they promised they would do. And then it was quickly obvious that like that was not a good call for a lot of companies. Like you look at many of these companies who raised over $100 million, valuation, at Series B, or even like Series A for some of the enterprise browsers, enterprise security, secure browsing. Just astronomical. Like nothing could compare to that, other than what we see today in AI investing, which has no basis in reality from previous investing. That's probably the only correlation I could draw between like the peak of cyber and the peak of AI. But then you see the brakes pump very hard in Q2 or Q3 2022, and that's when everyone realized, oh crap, we can't keep doing this because investors aren't letting the money go anymore. Or the LPs and the funds are not getting funded at the same rate because it costs too much money to lend money into. And there was this compounding effect of high interest rates. Businesses pulled back on expenses across the board, on tech, on people, on services. Cyber was hitting that, and then everyone just started cascading down from there and just piling on kind of the losses. And the famous saying I heard many times in 2022 after this was survive to 25. That's what everyone who was out fundraising or wanted to fundraise or wanted to get acquired or go IPO, that was kind of their mantra, was like, public markets are shut down. Prove that you can actually run a profitable business to 2025, and then we can talk about IPO roadshow again. But there was many people who knew they wouldn't make that path.
Yeah. Manage the burn and keep that runway. And so if you zoom in, we were talking about kind of the big picture of the summary of what each quarter looked like. If you zoomed in, what did the individual fundings look considerably different from what we saw in 2023? What kind of differences did you see there?
Yeah, so the individual fundings were, there was a lot less volume overall in 2023, but not as bad as you might think. So like this year actually had a bit of a kind of a bounce or a rebound effect, not like a dead cat bounce like many thought, where they wouldn't go anywhere. But it started off looking pretty dire. But even in
Yeah,
like
thanks
the
for
early,
that mental picture. Dead cat.
yeah,
What?
I didn't
I've
come up
not
with
heard
that. Economists came up with that. I
Okay.
thought that's a really interesting way to describe the economy, but okay.
By people who are dog lovers.
That's right. Yeah, yeah. I love both dogs and cats, by the way. But
Same.
yeah, the deal size shrunk in a lot of cases, and then the volume of deals kind of shrunk across the board. So I look at I kind of like to slice and dice funding by the stage, like early stage, mid stage, growth stage, late stage, or maybe not stage specific, like a grant or like a non-equity assistance or like a convertible note. Some of these things can be anywhere across the spectrum of your company. But you look at a lot of the early stage deals, by and large, they were not that far off on transaction level. So like if the average deal or the median deal in 2022 was like $7 million, the median deal in 2023 was 4.5. So it's noticeably lower, but not quite half, a little bit over half what it was. But that was averaged out from about 13% less deals than 2022. So even all that stuff considered, with how raging 2022 was at the beginning, then how hard it stopped, and then how slowly 2023 started off, it's had a pretty considerable Q3, Q4 that caught up on a lot of areas. But the most surprising for me was not that early stage funding took a dive, even though it did. It shaved off about 12% of where it was, but only 12%.
Right. Not that big.
Not that big a deal. So that means innovation still happened. Seed stages, pre-seed, early stage companies who were doing innovative things were still getting money. So iteration was still happening in our space. But that middle stage, that growth stage, that Series B, that Series C round, that actually got hit the hardest. And the ones who took those deals in 2022,
like I felt like I almost never saw C or beyond.
Yeah, they dried up overnight. So that's down like 28% for the year so far. But that's where most of the funding, the bulk of funding came from in 2021, 2022 was those middle stage deals. Like there were many, many deals that are 100 million plus. And that was the norm of a Series B, Series C, Series D kind of deal. Most of that dried up until about the very beginning of Q4 this year. So there has become a rebound, but it's still the starkest kind of difference. So the companies who were in that space that received that money, they're struggling the most. But the companies who made it past that trough of disillusionment and into the Series B this year, they're going to be much stronger as a result. So that to me that was super surprising because I kind of didn't expect that middle stage to struggle so bad.
Yeah. Well, and those are the ones much higher burn, right? So, I mean, I feel like I didn't match up my data on layoffs with what stage, or maybe I did. Maybe if I go back and look at my Notion, maybe I did do that. But I would expect to find most of the companies doing layoffs being somewhere in those later stages, mid to late stage startups. Yeah.
I would agree. Most of those companies hired extremely fast. Like if you look at kind of the growth trajectory, some would 5 or 6x headcount in a year or less, and then they would have 1 to 2 to 3 subsequent rounds of layoffs where they'd hit a couple hundred people each time. But honestly, even some of that's rebounding, and they're starting to rehire some of the same roles they let go. Hopefully a little bit smarter.
I did put the So let me. Let me share my screen again.
Yeah.
I'm gonna have to thank past Adrian for remembering to do this or thinking to do this. But yeah, I did add stage to it. And what does that look like?
Yep, that middle growth, and late growth too.
Series D, Series F, Series D, Series C, C,
Yep.
C, C, B, C, E, F. 1A, 1B, C, F, F, post exit, public, post exit, Series G.
Oh yeah.
Yeah. Okay. Confirmed.
Confirmed. Yeah. And honestly, I bet some of those A's are really B's, and some of those B's are really C's, because they're, if anything's consistent with VC and funding, is that none of it's consistent, and none of the rounds are ever the same size, and none of the valuations are ever the same size. So it's a bit tricky to really label this stuff, but you kind of have to draw a line somewhere.
Or it could be just, I imagine some of those A's and B's, they're like, you know what, like we didn't have a strong market fit anyway. Like maybe they're thinking about just spinning those down and not going forward, right?
Yeah, and honestly, those are the ones that are getting bought right now. For the past couple of months, those are the ones who are looking for that strategic exit, either because they have to or because they want to. Yeah, the early exit. Maybe that wasn't the path. Maybe the path is IPO all along, and then they're like, oh, hold on, maybe we're a better feature.
One of those enterprise browsers has exited, right?
Yeah,
one of those
exactly.
Two that just got like 100 million Series A or 200 million. I forget exactly what they got.
Yeah, they got 100 million Series A. They got 110 million Series B. And then they got bought for like 600 million from Palo Alto, Talon.
Talon. Yep.
That was an interesting time in secure browser world.
I've also seen a lot of, you kind of hinted at it before, with grants and debt rounds and stuff like that. But I saw some very creative, like anything but saying we're having a down round in some of these press releases and some of these raises, where it was very difficult. Like maybe they didn't even announce the number that they raised, or they announced the number, but it wasn't the next series. Or like somebody would say, oh, this is just part of our Series B, but like they announced their Series B 2 years ago.
Yeah, it's an extension. Yeah. Oh, that's a really good point. I mean, there were a ton of rounds that just kind of didn't declare, or they just tacked on to an open round, even if the round has been, was 2 years ago. Honestly, what happened was a lot of a lot of companies went back to their original investors and said, hey, can you throw more money in the pot, basically to keep us alive? And when you fund companies that much, you have to keep funding them a bit of money to stay alive. Otherwise you risk losing that much of your investment. But there was a ton of debt rounds where, like Arctic Wolf was probably one of the biggest examples of that in 2022, when they took like a 400+ million debt round, which probably should have been an IPO instead of a debt round. But they had to get creative. But I think they probably will try for it, next year. I think a number of companies will try for it next year. But I think
IPO. We'll try for IPO.
Yeah. Mm-hmm. Yeah, because it kind of got unlocked a little bit this year with like tech, whereas major, strategic acquisitions like Adobe Figma fell through, some of that stuff. I saw that. That's less attractive, but IPO is becoming a bit more because markets are open to it again. And that's all coming back to like sentiment. So like people believe that the stock market will get better because they believe the economy will get better, because they believe Fed will stop raising rates. And if the US Fed stops raising rates, then money will become easier to borrow. It unlocks like a whole series of things, and the rest of the world typically just follows suit on that, within a quarter or two of similar mechanics. So everyone's kind of waiting to see if Jay Powell is gonna say maybe we're good on the rates, and then that trickles that whole investor excitement again. And you can see that with an increase in deals like this quarter again. Like people are investing again. It started in Q3, but the number of deals started picking back up again, and now Q4 is still pretty far away from where it was last year, but it's picking up in a lot of ways in terms of like transaction volume too. So it's definitely heading in the right direction, which I think will make the rest of like the public market even better.
So one thing you said, just a quick point I wanted to make is you said, like the deal volume maybe was only 12% down over the previous year, but that's only if you consider flat from year to year, which this is a market that I think has been growing at like something like 30% year over year. So,
right.
Looking at it in terms of like the previous momentum, it's down more like 42%, right?
Oh yeah, no, that's a great call out too, and that's definitely some of those. It's hard to like not look back at that data and say like, yeah, but it was supposed to be a lot better. We're supposed to be 30% up instead of down a bunch. I think a lot of people hit reset on that too, just because they were kind of forced to. This is going to be a footnote, like in 3 years, this will be like the COVID footnote years where they'll just say weird stuff happened in this vintage. Don't count it.
Yeah. The history books will have little footnotes. Yeah.
Yeah.
Absolutely.
And so it's going to be one of those strange ones.
So do you feel like, does it seem like investors are hitting the reset button on some of their later stage investments also? And like, I mean, typically we have the investor world kind of separated. Like I feel like there's not a whole lot of VCs that are both early stage and late stage, right? Mm-hmm. Like typically there's kind of a handoff where the early stage folks get out after B, and then you see the more institutional investors, the Tiger Globals and the SoftBanks and all those jump in those later stages. But I kind of get the sense, like, since we haven't seen any of these C's or D's, we haven't seen these companies get picked up. A lot of these investors seem to be just focused on their next investments, and those folks that are at the C and D level just kind of out in the cold, like on their own. Are you getting that sense?
There is a lot of like the C and D round. A lot of them are looking for that strategic acquisition and that merger. Like that's really what a lot of them are doing. Like you are right there. There are very few companies that swing wide and like go small and go wide. Like you can think of like a handful, like maybe Andreessen, maybe a couple like on that caliber, but most have basically buddy relationships with larger VCs or larger private equity backers who kind of help them bridge up or down. And so that's pretty common in this space too, where you'll see like somebody who always does early stage, like up to Series A, and then they bring in, their big friends over at DFJ or KKR or some massive, private equity group to help them do the B, C, D and beyond rounds. So you're seeing, kind of more of that like partnership kind of investing. So some of the big ones are punching down. Private equities just like sitting on a mountain of money waiting to just pass back and forth identity companies again, because that's what they do. And so like that, I think that's kind of like the next big wave too, as private equity just kind of buying up some of these really, really big strategic ones and then doing like consolidation plays. But yeah, if you're sitting Series C, Series D, in like the past 2 years, and you're not at the top of the market, you're going to have a pretty rough time right now.
I wonder what we'll see there with the private equity, because usually they're looking for a certain growth rate, a certain revenue rate. Like there's very much a calculation I think they're looking for, and kind of surprised I haven't seen much of it yet. I wonder if that means that these C's and D's aren't quite there, aren't quite hitting those the rates that the private equity is looking for, or like SDG is still unloading. The last generation of security companies, they're still scrapping them for parts and rebranding them. So,
yeah, no, that's going to happen too. And just like to give you an idea on volume too. So like in 2029, I tracked like 29 different private equity, like funding rounds, and not even acquisitions, just like private equity investments, to the tune of like 2.2 billion. So far in 2023, I've tracked 23 funding investments, but only for 500 million. So it's way less volume on that. Now,
less than a quarter.
A lot of that could have pivoted to acquisitions. A lot of it's still kind of waiting, because it is a lot more calculated money, and it is a lot more of a math equation to what to buy.
They don't have to move as quick either. They don't have this LP mountain of cash that they have to get moving and operating.
Yeah, exactly. Whereas like, especially some of these mega funds like SoftBank and other, they have like, sovereign wealth fund money that has to go somewhere into the tunes of, hundreds of billions. And so like they're investing in lots of things to give some leverage and some return, because it has to go somewhere. You can't just sit.
And it goes somewhere.
It definitely goes.
SoftBank does move money places. You can't deny that.
That's true. Not always good places, but yeah.
I wasn't going to say. Well, I don't mind saying it, but they've had some. They've had some rough times. I think they've had their own layoffs as well.
Yeah, they have.
Yeah. Um, yeah, so we've talked about market trends here. So yeah, let's dive into maybe some more of the category trends we've
Yeah.
seen. Let's jump more on the technical side of investing and in the security market. And what have you seen? What has leapt out at you that's interesting? Or I could start off. Certainly I
Yeah.
saw a lot less blockchain and crypto stuff.
Yep.
That's had its own winter, and I think it's harder to justify building a company to support less and less market there, less market strength, less of the Coinbase's. Coinbase has a lot less competition now,
Yeah.
right?
Yep.
With FTX gone, and I don't know where Binance is at, but there's less and less players there. But it seemed like it seemed like we saw less like traditional AI stuff, and ChatGPT just kind of well, you've already mentioned it, like stupid money going after anything labeled AI, including
Yeah.
like I've seen some of these acquisitions where I'm reading the press release and I'm like, that's not what this company does at all. Like, when did they have the AI branding? Like, where did that come
Yeah.
from? Like, I'm pretty sure a quarter ago there wasn't any AI in their messaging or
Yeah.
marketing at all.
Yeah. Well, so you're right about that. There's a couple trends that kind of stick out. Like obviously the AI trend is sticking out. So there's been a couple flavors of that where there has been kind of like this recent wave of like existing companies who had a presence who now all of a sudden have an AI thing. Like they are, yeah, we've always been AI, or like kind of like the Dark Trace or something. Like
Yeah.
we've been doing AI since before it was called AI.
The age
Um,
of gaslighting.
yeah, so like they're leaning on that. So you saw companies doing that. You saw the very first wave of companies come out that were doing like a couple different things in AI or around AI security, and they were mostly knee jerk reactions. So one was, holy crap, block this AI because I don't know what it is and it's a legal
Yeah.
nightmare. So there was the proxies, the CASBs, the LLM DLP companies that came out of the woodworks doing this very niche thing that they do. The bigger players then realize, oh yeah, I can just turn that on, like Zscaler or like Netscope or some of these other players who've been around and who are in the SASE or SD-WAN or CASB game already, and so that they started looping onto that. You're now starting to see like kind of the next iteration of AI security where they're trying to be a bit more thoughtful about it in terms of either protecting your own LLM models that your company may run from adversarial models or attacks,
Mm-hmm.
which is just effectively API security, but it's for LLMs APIs instead of
AI posture management, security posture
yeah,
management.
posture. Yeah, exactly. There's a lot of that. And which, to be fair, I think the posture managementification, which is like just a made up term, but I think that's a good thing for security because I think it kind of raises the bar a bit and it's a bit more
It's
pragmatic.
more of a
And,
holistic focus. Yeah.
yeah, and it's a lot of it's more black and white. Like you can't argue that the S3 bucket is or is not open. Like it
Right.
is open. Now fix the permissions to make it not open. So like
Yes.
it becomes more
Much more
binary.
concrete than trying to find, the latest threat in something. Right.
Yeah, and it's measurable. You can actually burn it down, which I think is good. But that's part of the challenge too. So like getting around that and understanding like, all right, how do I then move kind of beyond just those basic posture management pieces? So that piece is coming, and and is showing up a lot in the big spaces. But now people are starting to ask like, you say you do LLM security, but which part of the LLM are you doing it? Are you preventing me and my employees from putting things that shouldn't
Right.
go in, public
Input,
LLMs?
output,
Yeah,
DLPs
sanitization,
basically.
DLP, legal policies, things like that. Like, hey, you can use ChatGPT, but it has to be ChatGPT Enterprise through Azure only. Are you like, are you directing traffic, or are you actually trying to secure me and the models, LLM models and AI training data that my company is using? Because now more companies are coming out of the woodwork trying to use that as well.
Yeah,
Like
I
similar.
think there's a data security, maybe a DSPM angle there, where you want to
Mhm.
make sure the correct data gets trained and shared with those models, and not the incorrect data. And that one of my predictions for 2024 is we will see people pulling private data out of the support chatbot or the website. In the news segment today, we're going to talk about some of these chat GPT enabled chatbots that auto dealers have had on their websites.
Oh yeah. Oh, that's awesome.
And all the crazy
Make
stuff
me a Python script, Chevrolet dealer.
Yeah.
Yeah. There's all kinds of abuse for that too. As well. Like, so there's definitely those big angles as well. But people are starting to ask a bit more. So it's good to see, like, from a trend, but category trend perspective, that iterate a bit more. Obviously, in the same vein, like, you can't, it's as crazy of a crypto winter as there's been. There is still a shocking amount of money invested in Web3 and blockchain and security. So there's actually been a bunch of security investments this year in that space because, as I always like to say, if when it comes to moving money or when it comes to transacting, like, it's always going to be cool to protect people from getting robbed. So, like, whether or not it makes sense, whether or not you believe in the currency system that is, digital ledgers and things like that, it's kind of irrelevant. If people start getting scammed, everyone gets involved. Like, governments get involved, regulations get involved, and so people hop out of the woodwork and they start funding that stuff because there is still money to be made, like actual, like fiat currency money to be made from protecting some of those transactions. So it's
I saw even Ledger got hit. Even Ledger had a breach, and Ledger's been pretty serious about security from the very beginning. They've understood how important that is, and they still got hit with some pretty basic stuff, it looked like.
Yeah, I mean, it just shows like it's possible. It's a very hard game to play, but it's possible for anybody, especially when you're like the leader of security in that transaction space. So I don't think that'll go anywhere. And honestly, the UK government's big on crypto in general. So we have like a whole big innovation with A16Z crypto here with the government. So that's a big drawing factor. Okay. Yeah, like financial regulations are different outside of the US. And so, like, there's a lot more of that still happening in Europe and in Asia, like, by and large, like a lot of parts there. So I think you'll see a lot of the investments kind of shift that way to, like, Singapore, to, like, the UK.
I mean, one of the biggest problems is like the base of the technology, that immutable ledger, isn't very good for supporting consumer protection. Like theft is forever, unless law enforcement can get involved. And like it's an actual cryptographic transaction where, there's not somebody sitting in a seat that can do a chargeback or a retrieval or something like that. Right.
That's right. Yeah, it's very true. I think, but it's like immutability is actually one of the most strong points of it, because it's like the best auditing platform you can ever get. So you can always trace back, like, who moved the money, what's Mixer accounts, which whales
you need to hit the undo button.
That's right. You can't undo it, but you can find out who did it. And I think that's like, so there's been a huge wave of, like, basically like crypto auditing firms that find this stuff, that, like, find out where your money went, and they can find out where Mixers and Mule services are and all that stuff.
Yep.
Which I think is pretty cool. I would also say, like, in terms of trends this year, identity threat protections had a big moment, and, like, even, look at Okta just buying Sparrow this week, or announcing their intent to acquire them for $100+ million. I think that's
would you include identity verification services in that?
No, because honestly, identity verification, separate trend. Honestly, like, that's a bit lumped into, like, the fraud and financial crimes kind of protection, which is, like, always been going on. Like, if you look at the broader space of, like, know your customer, or anti-money laundering, or know your third party, like, that market has, like, existed forever, that people have transacted, and it's mostly, like, servicing banks and other financial institutions. And so that point of verifying customer identity is, like, to me, kind of a separate bucket than, like, hey, I have an overly permissive account, and I'll have an account abuse in my, like, AWS instances, or I have an overly permissive API and things like that. So I think that's, like, both of them are taking off because of fraud, but then it's like, ITDR, threat detection and response, is, like, a lot more closely to that posture management side of the world.
Right.
That kind of thing. But that's had a big moment. And And
Pretty critical, as we've seen with Okta. Like, that's going to be a target.
it is, and Okta is a super special case too, because like no matter how many breaches they get, their stock still goes up. Investors still love them because there's frankly no competition, and it kind of doesn't matter if you get popped all the time if you're the only.
It's like Microsoft in certain categories. You have to use them.
Yeah. And it's honestly at a point people throw their hands up and say, well, if Microsoft gets breached, what are the rest of us have? And so like you kind of just roll with it and say, well, that's what insurance is for, and you move on. And like, is that the right? Is it healthy? I don't know, but can you change that? I don't know either.
What else are you going to do?
Yeah.
So let's do a few predictions for 2024 and then wrap here. My spicy prediction is that companies trying to use LLMs for detection and response or for enhancing SOCs, I think are going to fail harder than other SIMs and other detection response technologies before them have failed. And I think that's the wrong place to. I don't think LLMs are ready for mission critical stuff. I think they're perfect for going after the most boring, mundane, like fill out this, what's it called? The SIG
like
Lite
security questionnaires,
filling out vendor management, third party risk management survey or questionnaire, and and just automating that work that people already hate to do. They're already just, let me look at the old spreadsheet and copy and paste some responses in because all the questions are slightly different. I think those are like doing support, right? Like I should never have to wait on hold for support anymore now that we have LLMs. Like that is as mundane and straightforward. Like they're all working from scripts anyway. The turnover is like 100% over 6 weeks at some of these call centers anyway. So like that's where LLMs are going to shine. And because when they make mistakes there, it's acceptable, right? When they make mistakes with detection and response, not so much. I think that's the wrong place to go after for vendors. And I've been telling folks that. So that's my prediction.
No, I like that, and I think LLM is just like one iteration of what the public will consume of what AI is like possible to do. So I think it's it's like too narrow in my mind. Yeah. Like there's going to be more after that. Honestly, I think I agree with that prediction as well. I think I said last year I thought no code security would take off. I think I was wrong about that. Like I don't think that's I think that was too early.
I don't know. There's a big Tynes fan club out there. There's a really big Tynes fan club out there.
Yeah, and honestly, it's and Tynes is great for that too. I think there will be more services that go out there, but I think there will eventually be like a middleware layer that helps like kind of manage even some of those services. Especially if you look at like every product has a SOC, like AI SOC agent now or AI support agent.
Right.
I don't need 10 agents. Who's going to manage the agents that manage all the agents? Like so I need some overhead. Layer.
Yeah.
It's too much overhead and it's not connected enough. So like those platforms are going to shine like the most if they can become the middleware interface where I can just ask a question and it does the answers, or give a instruction and it does the answers. But yeah, I think identity will still continue to shine. Like the identity threats are going to continue to go as well.
Yeah, and that's something we haven't focused on enough on the podcast, especially considering CRA owns Identiverse, which is one of the largest identity security conferences out there. So yeah, we should definitely focus on identity more on this podcast in the future as well.
Yeah.
All right, good stuff. So tell the people where they can find your newsletter and sign up for it, so they don't have to listen to my news segment anymore.
We'll totally still listen to your news segment too, but if you want to go straight to the source, if you like some charts and some other like analysis type stuff, every week I write a newsletter on returnonsecurity.com. I also publish on LinkedIn and Twitter. So like if you want to connect me there, LinkedIn's probably the best way to get a hold of me. Other than that, just really appreciate you guys using the data and like talking about it. And I love seeing how people use it, and gives me ideas and keeps me motivated to keep doing it.
And that I just now saw that tweet thread where you had the industry analyst trying to come up with a category, and for every 10 likes, he was going to get more and more frustrated. That was the best thing ever.
Awesome. Yeah. If you like memes and the trolling, I do a lot of self-trolling on Twitter as well. So I make fun of me and myself in the industry and like all kinds of stuff. I crack myself up with that stuff too much. But
check out the newsletter for the humor and the and the other if you're our generation, 90s hip hop references, stuff like that.
Yes. Wu-Tang Series B is on the swarm.
All right, Mike, thank you so much for joining me today on Enterprise Security Weekly.
Thanks for having me, Adrian.
It was a pleasure. Stay tuned. When we come back, we're going to talk cybersecurity certification with Pascal Menezes from MEF. I'm not sure if I should pronounce that. We'll ask Pascal here in a moment.